One thing is that you see investors pricing in now 2 rate cuts this year. There were 3 priced in. So the outlook is still a little bit sour, but maybe not as dire as before. You see so much under the surface because you're also a restructuring advisor. Do you think that the fear is warranted?
Well, I think the chair said at the last interview he did, he's looking to the Treasury Department and to the White House at this point to see the direction of their policy. Tariffs are a big change in the potential economy of the United States and the world economy. And so that will influence both short-term price pressures as well as economic activity. So I think he's kind of frozen for a while until he sees really where we're going with tariffs and how the rest of the world reacts to those tariffs and whether we get a growth slowdown as a result of retaliatory tariffs, high tariffs being imposed here and retaliatory tariffs being imposed outside.
Can't we already tell? I mean, Jim Farley, the CEO of Ford, said these tariffs or the threats thereof are causing chaos and costs. And it seems to me that in the next round of CPI, PPI, and PCE, we're going to start seeing that shine through.
Yeah, I think just anecdotally, I think some of us are already seeing prices go up on the things we buy as a result of suppliers and sellers getting ahead of it. I think, in the short run, tariffs are an increase in the price level, but thereafter, it may just stay at that level. So the rate of change may not be great in 2026 as it will be in 2025 when the tariffs are imposed.
Well, but Jim, all this uncertainty in not only tariff policy, but we don't know what's going to happen with regulation and tax cuts are in question, right? Mass deportations. That seems to be affecting everything from small businesses. When you look at the NFIB, no expansion, to Morgan Stanley and Citi saying like the M&A bankers and the IPO guys that we have not really necessary right now.
Yeah, I mean, listen, I think one of the 2 big pieces of legislation that President Trump got through in his first term was his USMCA, the tariff deal, the trade deal between Mexico and Canada.
It's the greatest trade deal anyone's ever seen.
According to the White House, yes. And as a result, I mean, that's been in place now for 7-8 years. And U.S. manufacturers, which is the sector that the Trump administration now wants to promote, U.S. manufacturers laid out their supply chains in Canada and Mexico based on the rules of the road established by the USMCA. So, that no one should be surprised that they were surprised by the threat of imposing 25% tariffs on Mexico and Canada, our 2 largest trading partners. And why are they our 2 largest trading partners? Because the USMCA created a roadmap for how to take advantage of relatively lower wages in Mexico and take advantage of relatively lower commodity prices in Canada to set up your supply chains for domestic manufacturing.
Aside from tariffs obviously creating a lot of havoc in the market, that's fair to say, on tax cuts, one question I have, this was supposed to be one of the biggest parts of the pro-growth agenda, that and lighter regulation. But how likely is it that we see a lot of those promises come to fruition? And if we don't, does it stifle that pro-growth story?
Well, let's first be clear and level set, right? So the extension of the 2017 Tax Cut and Jobs Act is basically the status quo ante. If it isn't extended, you would have a tax hike on households. The corporate tax cuts were made permanent, but the household cuts were not. So if they don't extend them, you're going to get a tax hike. But if they do extend them, it's just the same tax regime we're in today. Now, President Trump, as he campaigned, talked about further tax cuts: no tax on tips, no tax on Social Security, no tax on overtime. That would, the estimates are all over the place as to what that cost to revenue would be, but let's assume it's somewhere between $200 and $300 billion a year. So over the 10-year period, another $2 to $3 trillion worth of incremental debt for those tax cuts. at a time we're already running a deficit equal to 7% of GDP. So let me just stop there a little bit, because this is really, to me, I guess if you're a hammer, everything looks like a nail. If you're a debt restructuring guy, everything looks like a need for a debt restructuring. Today, our federal debt to GDP ratio is basically 1-to-1. We're running a 7% of GDP deficit this year, okay, which means the debt is increasing by 7% a year, whereas the economy has only been growing at 2 to 3% a year. So we're basically becoming more indebted over time because the growth of the economy is not outpacing the growth of the debt. So there's a massive need for what we call in the trade fiscal consolidation. We need to get our house in order and create revenues closer to spending.
Well, and they're hoping to get those revenues with tariffs, I guess. In terms of the cuts, I mean, Scott Bessent has this 3-3-3 plan, but it seems so unrealistic to get the deficit from 7% down to 3% if you're only able to find like $58.26 in waste and fraud, right? Because they're not attacking Medicare and Medicaid and military spending. They're trying to fire people at U.S. aid,
right.
Which
also, guys, especially as growth is expected to slow. I think that's a part no one's talking about here. That how do you grow into that if the GDP forecasts are being revised?
Hopefully the tax cuts and deregulation
so
will take care of that.
let's be fair to Mr. Bessent.
Yeah.
He's talking about a 4-year trajectory to get the deficits down from 7% of GDP to 3% of GDP. He's talking about goosing the growth rate of the economy to 3%, not in the sort of low 2s, high 1s that we've been in. And trying to moderate inflation by having more energy production. With oil in the 60s, you're not going to get more energy production here in the United States. It's just not, return on capital isn't there for that. So let's put aside whether or not that's the best way to deal with inflation. How do you goose the growth rate? Well, the theory of the administration is that deregulation is going to free animal spirits in the business community, that the tariff walls are going to create a surge in domestic investment to produce, because behind those tariff walls you can be more competitive against foreign competition. The problem with all of that is it takes a lot of time. Deregulation is going to take a lot of time. The rules that are currently on the books that they want to get rid of, the agencies actually just can't say done by executive order. They have to go through a rulemaking process. They have notice and hearing, and they have to unwind the regulatory state is going to take, even if they move with lightning speed, is going to take a year or two to fully unleash the animal spirits. And with regard to setting up new production facilities in the United States and reorganizing our supply chains, that's a multi-year effort. So, and you're doing it against the backdrop of high tariffs, potentially retaliatory tariffs, which could be a growth slowdown, as you say, Sonali, which means that tax revenues might shrink in the short term, and God forbid we have a recession. And then not only do tax revenues shrink, but expenses go up because of all the counter-cyclical programs we have to ease the pain of a recession.
I want to pull up BCY on the Bloomberg terminal because you can see just how much you're seeing bankruptcies, particularly loaded to the consumer discretionary sector. And something about this that is a bit deceiving, Jim, is something we were talking about in the commercial break here. Actually, you're not even seeing the bulk of the pain in the Chapter 11 filings. You're seeing it in the way that creditors are working out the way they're trying to keep companies alive through additional debt that is coming at high interest rates, frankly. Even if you see the Fed cut twice this year, does that relieve these companies of the pain they're struggling through of refinancing at these higher rates?
No. The answer is no. So, you look at the credit markets and the corporate credit markets, there was a huge surge of refinancing activity that went on when rates were low in the early post-COVID period, when the Fed had driven rates back again down to virtually zero before the bout of inflation. Most corporate debt has a maturity of 5 to 7 years, so we're now at the end of the maturity of that wall of refinancing that went on there. So now we've got a new wall of refinancing that's required at much higher interest rates. So even if the Fed knocks 50 basis points off the low end of the curve, the short end of the curve, the far end, the belly of the curve out in the 5 to 7 years zip code, companies that did their financing back in 2020, 2021 are now going to be refinancing in a much higher interest rate environment. As the uncertainty, the general macro uncertainty creeps into the credit markets, you're seeing a slow, not dramatic, but a slow uptick in spreads in the non-investment grade market. And so both a higher base rate and higher spreads are going to create higher interest burdens.
Why are spreads so tight right now? I mean, especially if you see an increase in bankruptcy or a concerning absolute number of bankruptcies, why do you have spreads, even junk spreads, so tight?
There's just a tsunami of credit availability right now. There has been, the growth of the private credit businesses, which is unrelenting and continuous, which in some ways really recycling money out of the insurance industry, which used to be big bond investors and continue to be bond investors, into a series of specialist funds to do their underwriting. There's plenty of bank liquidity available.
And private credit.
Yeah.
Oh, as I say, private credit.
Yeah.
Well, to that end, is this masking some of the pain that's really under the surface? What are you seeing? Because when you think about it, banks say, well, consumers are fine. But Bank of America, an average FICO score is well over 750. It's almost 800 for many of its credit lines. And so you're not really seeing the American consumer there. You're not seeing the painful companies that are maybe being turned away from a JP Morgan type firm today.
Yeah, so you take the 4 years of pretty high inflation. And while there has been wage growth to compensate, that wage growth is moderating. So you're really seeing the consumer starting to be pinched. And that's why you're seeing the first set of distress show up in consumer-oriented companies. Again, this is with plentiful credit availability and a change in the capital structures, particularly in the middle market arena, where you have not so much bank finance, but private credit. And private credit is usually one or two lenders. So when a company gets into trouble, even a private equity sponsored company, you can have a conversation like this about what are we going to do.
And nobody else knows about it.
What are we going to do about it? And so there's an awful lot of what we call liability management exercises going on in private conversations between a private credit fund and a private equity fund, or a private credit fund and a family-owned business.
So I've been bringing up these stats a lot lately that bank balances have declined over the past 12 months back to pre-pandemic levels, this across all income groups. Wage growth has slowed over the past 12 months across all income groups, and that Americans' inflation-adjusted debt is rising past 2019 levels across all income groups. And yet everyone says never count the American consumer out. And I've been doing this for 25 years. It's a good thing to say,
yeah.
Right? Why is the American consumer so resilient, and does that continue?
It's about credit availability, and just look at the federal government, right? As long as people are prepared to fund, a $1.7 trillion deficit, we the Congress can continue to spend with abandon. As I said earlier, I think we're coming to the end of that cycle because we're at the point where the debt's growing faster than the economy. But as long as there's the last lender there willing to, lend you that dime to finance your spending, you're going to take it when the alternative is, a restructuring.